Almost 18 years ago, my life completely changed. I became a father. Fast forward today in 23, I need to pay for this kid's education. So we have an amazing way of doing that in Canada, and it's called the RESP. So that's an account that you put money there, the government help you out, you grow that account, and then once your kids goes to college or university, you can withdraw some money out of it, and this is how you can pay for tuition fees without getting hurt too much in your budget. Dividend growth investors, bonjour, my name is Mike Héroux, and today we are going to talk about how to build an RESP at the stage where you start to withdraw money, because it's one thing to build it and it's another to actually generate some income out of that. So it's similar to how you can build a retirement portfolio, but this one has a few particularities in a sense that now I have my oldest son is in college, I need to start withdrawing money, but I have two other kids where I still put money into the RESP. So at the same time, I'm in growth mode and income mode already together. So just to let you know how I've built it in the past, what was interesting is I started with a small amount. You know, you're young, you have young kids, you don't have that much money. So I started to pile a little bit, like $100 a month or something like that, getting the subsidies from the government. So an additional $300, which definitely helped. But at the beginning, I couldn't buy stocks, right? So what I did back then is I invested in index funds. So they're similar to ETF, but back then there were less ETF. I didn't know much about ETF. That was keep in mind, that was 15 years ago, something like that when I started. So long story short, I started with that. I built a portfolio that was at least $10,000, $12,000. And at that time, I was doing a lot better with my own portfolio, my RSPs and so on, by buying dividend growth stocks instead of following the market. So I decided to make the switch, sell all my funds, bring in that to my broker's account, and here are the results. So as you can see, this account has grown very fast since inception, more than 5 years ago. I can't remember when I started this account as a brokerage account, but it's at least 6-7 years. Annualized growth rate of 13.57, so that grew very fast, that doubled. And today I have almost $40,000. Actually, I had $40,000, but I started to withdraw a little bit money out of that last year. And now today we're going to do a deep dive on what are the stats, how's my sector allocation, and what is in my RESP. So stay tuned, we're going to back directly into DSR Pro. All right, so we are now back into DSR Pro. This is the system that I use to manage all my accounts, and obviously it's a paid service for all my members. We now have more than 3,000 investors that trust Dividend Stocks Rock, and more than 2,000 of them are actually Pro members. So the Pro membership allows you to build as many portfolios as you want. So for you, for your spouse, I know for Canadian, we have like TFSAs, Lira account, RESP, non-registered holding companies. You can create all of them and then you can consolidate them into one report or watch them separately. So today we're just going to look at my RESP. As you can see right now, my portfolio value is at almost $39,000, so $38,400. Interestingly here, my book value is at $37,600. Why? Because I made a major move over the past few months where I sold all my growth stocks and I wanted to increase my portfolio yield. So you can see now my portfolio yields at 3.3%, which is not as high as I would have hoped, but at least it's a pretty good start to start generating money. Keep in mind, I live in Quebec. Tuition fees in Quebec are very cheap. So at this point, I need about $2,000 a year to withdraw from that account to pay for tuition fees for my son because he's still living at home. So cost of Cégep is not that expensive. So long story short, right now I have like $700 in cash in the cash account. I'm still adding to this RESP account because it will fund my tuition fees for my 3 children, but at the same time I have an annual dividend payment of $1,200. Next year it's going to be around $1,300 because my average over the past 6 years, if I look at all my portfolio, in my entire portfolio, the average dividend growth rate is 6.5% per year. So I can expect that between the dividend that I will get every year plus the money that I put, I will have more than $2,000 a year to withdraw, and until they go to university where I will need to build a little bit more cash. So that's why I have this strategy in place. So in terms of allocation, well, as you can see, we are at 98% invested in stocks and only 2% in cash. So the 2% in cash is just to have enough cushion, so whenever I need money to withdraw it from to pay for tuition fees, I can do that. I don't need more than that at this point, and I rather let most of the portfolio generate some solid income and instead of like seeing some cash laying around and not working for me. Second step, allocation. So I'm a little bit overweight into financial services. We're going to look into that later on. But as you can see, 27% of the portfolio into financials. That's also a risk when you have like 30 stocks. You have like about $38,000 divided into 10 stocks. It's a little bit hard to have like a great diversification. I wanted to have something very concentrated, but I'm very comfortable with what I have. You can see that the rest of the sectors is well diversified among utilities at 17%, real estate at 14%, and then we have communication services at 13%. So those are like probably the most generous companies in terms of yield. So you have like financials, you can think of banks, utilities, real estate, telcos. You probably guessed that I have either Bell or Telus in this portfolio, but this is how I've made able to generate some income and get a yield of 3.3%. Obviously I have some tech stocks here at 12%, consumer staples at 11%, and then industrial at 6%. In terms of prorating in dividend safety score, as you can see, I don't have many positions, but I really focused on quality. So all of them are either exceptional buys or buys. So that gives me a very solid core portfolio. And I have 2 companies with a dividend safety score of 3. You can guess it's probably around the REIT or the utility sector. So we're going to take a look at it in a moment, but most of them are very strong dividend grower. Now we're going to go back a little bit higher and we go here in the holdings because that's probably the most interesting part, right? What I like to do is usually to put them in terms of weight. So the largest weight until the smaller one. You won't be surprised to see National Bank as the largest position I have in this portfolio. I had it for a long time. I just added a little bit more on this one, mostly because the yield is very good at this point. We're at 4% yield. I'm very bullish on National Bank. You probably know that already. Another one that I love is Granite Real Estate Investment Trust with a 3.85% yield, and it's a great balance between growth and paying a decent yield at the same time. So I kind of like having Canadian banks, REITs like this that will provide me with some income, but I also can expect some growth coming from them. Now moving on to the telecom sectors. Well, there you go, another companies you won't be surprised to see. TELUS Corporation paying a generous 5% yield right now, expecting like 6-7% dividend growth rate going forward. Definitely a solid company working, operating in an oligopoly. So again, very solid pick here. We have Apple and Alimentation Couche-Tard. The reason why they are still there is they used to be a large portion of my account. That explains also why I've been doing so well over the past few years. But now that I'm moving towards a point where I need to withdraw money, I lowered my exposure to those two. So obviously Apple was like my top performer here. Now they're back to 11.5% and 10%. Still big chunk of my portfolio, obviously with those yield at 0.55 and 0.83, that lowers the bar a little bit, but it will generate some more growth going forward. Going down after that, what we have Royal Bank of Canada at another almost 10%, 4% yield. that was a great combination between National and Royal Bank. I love the two of those banks because of their diversification. So they're not just about savings and loans, they're also about capital market, wealth management. They're well diversified, and they generate more than 50% of their business is not coming from interest income. That's why I feel comfortable having such a large position into the financial sectors. Now I have two utilities to close that loop. Brookfield Infrastructure. It's pretty much like buying an ETF of utilities. If you haven't looked at this video already, I've made a complete set of videos on the Brookfield family. So BAM, Brookfield Corporation, Brookfield Renewable, and Brookfield Infrastructure. So go in the link description below, check out the channel. I've just done them not too long ago. I've also written a full report to understand what's the difference between BIPC and BIP.un.to. So the trust units, the corporate class shares, you can download the report as well at the end of this video to get more information on Brookfield family. And I have also an exposure to EMRA. I wanted to have like some utilities here. Why? Because they pay great yield. So again, for EMRA, we're at 5%. Obviously, this one dividend safety score at 3%, at 3 out of 5, mostly because I expect the dividend to grow, but not that much. This one is really like a deluxe bond in my portfolio. So a stock I don't expect much in terms of stock price fluctuation. I don't expect to skyrocket it, but it will pay a very solid dividend. It helps increasing the yield of my portfolio as well. So those are the reasons why I added EMRA on this one. It's been a long time hold for this one as well, for like more than 5 years for this. Finally, I went into a little bit of play money, so a small position. And as you can see, I've put like my strong conviction buys with like more than 10%, and then I reduced like two of my favorite stocks, Apple and Alimentation Couche-Tard, back to 10% just because they have a lower yield. And I've put a little bit of play money here in Severia. It's a small cap, but I like the dividend triangle. I like the expectations going forward. The company grows a lot by acquisition. They should be able to improve their margin now. They got hurt with inflation in 22. I think better days are ahead because the need for all their products, for their elevators, their adaptation into cars for seniors and other people that has mobility issues. I think with the demographic that we have right now for the next 20 years, it's going to be a growth stock. So that's why I decided to add a little bit of that. And as I mentioned earlier, we have like $700 into the cash account. Combining the $700 plus the monthly payment that I still put at $100 a month. I don't need more than that at this point. We're getting close to $40,000 for the portfolio value. It will generate like $1,200 and $1,300 and $1,400 a year in dividend going forward. I do not expect to touch that the principal at one point for a long time until my children goes to university. So it's going to take a while before I need to withdraw a little bit more. In the meantime, very solid business and that are in my portfolio. And eventually what's going to happen is I'm going to sell more of Alimentation Couche-Tard and Apple because they have low yield and they are growth stocks. So I'm going to benefit from that growth and generate some income. But that's probably going to happen only in 2-3 years. So that's why right now I only get 2% in cash, and it's more than enough. All right, guys, so I hope that you have enjoyed this quick overview of my portfolio. If you want, I'm going to generate the report right here so you can create a report. So you can see I have like a bunch of reports I have here. I'm going to create the RESP report and I will let you download the full report. So as you can see, here's what you get. It's a PDF format with all the stats that I've mentioned today. So the 10 holdings, the average portfolio yield, the allocation. So you get all that information, and even more interesting is you'll be able to get a full review of the latest quarter for each of those stocks. Obviously, if you click on the DSR stock cards, you will not get access to it, but at least it gives you a feel of what we do at DSR. So in the link description below, you can download the RESP book for my portfolio. So you get like full details on everything. You can can see I'm super transparent on there. If you have any questions about the RSP, about how I've built it, why I have like a US stocks in it, we haven't discussed that because there's tax implication. So let me know your questions. I'll be more than happy to help you out with how to manage a RSP portfolio. And until the next video, next Thursday, don't forget to stay invested.